Good afternoon, distinguished ladies and gentlemen. Let me welcome you to the communique briefing of the Monetary Policy Committee meeting that was held between yesterday and today, the 21st and the 22nd of September 2020. The Monetary Policy Committee met on Monday 21st and Tuesday 22nd September 2020 in the light of lingering uncertainties associated with the COVID-19 pandemic and downturn in crude oil prices. These uncertainties, which centered primarily on the pandemic, will be fully subdued and the oil market return to normalcy, have resulted in persistent weak aggregate demand, disruptions in global supply chains, mixed price development, volatile and downward trending oil prices, as well as rising unemployment. The committee reviewed these developments and assessed their impact on the domestic economy in the first 3 quarters of 2020 and noted the outlook for the rest of the year. 10 members of Monetary Policy Committee were in attendance at this meeting. The global economic developments. The committee observed the moderate improvement in global output performance without widespread recession in the second quarter of 2020. This followed the sharp decline in output growth in the advanced economies and some emerging market economies, as well as the risk of further deterioration in global output growth associated with the lingering shocks from COVID-19 pandemic. Global exports and international travels, however, showed signs of gradual but sluggish recovery as countries relaxed restrictions to allow for resumption of economic activities. The International Monetary Fund, therefore, remained cautious of its global growth forecast for 2020, which was hinged on the near-term containment of the pandemic. The likelihood of a second round spike in the rate of infection is, however, undermining hopes of an early return to normalcy. Oil exporting countries are also likely to face further revenue shortfalls as a result of the decision by the OPEC Plus to reduce its production ceiling from 9.6 million barrels per day to 7.7 million barrels per day. Due to these headwinds, we suspect that the global economy may suffer a deeper contraction in 2020 than the 4.9% projected by the International Monetary Fund. These may also dampen the projected recovery in 2021. The MPC observed the huge injection of monetary and fiscal stimulus into the global economy, noting its medium-term inflationary potential. In major advanced economies, inflation mostly remained below their 2.0% long-run objectives as the recovery of both global aggregate demand and supply remained stalled. Across the group of emerging markets and developing economies, price development remained mixed, reflecting the diverse structure of these economies. The exchange rates of EMBs continued to be under pressure as global capital flows were subdued, reflecting investors' preference for gold as a safe haven. With the unprecedented and coordinated injection of liquidity by central banks and fiscal authorities globally, the risk of another financial crisis post-COVID-19 can no longer be overlooked, as this may likely crystallize into a double-digit global recession when central banks across the globe move to normalized monetary policy. In the global financial market, conditions remain relatively tight, reflecting continued uncertainties. Thus, while markets are showing moderate signs of recovery, financial conditions are yet to ease fully as investors remain cautious of the lingering risk of a second round of lockdown. Domestic economic development. Available data from National Bureau of Statistics show that real GDP contracted by 6.1% in the second quarter of 2020, compared with expansions of 1.87 and 2.12% in the preceding quarter of 2020 and the corresponding period of 2019, respectively. The development ended the 3-year trend of low but positive real GDP growth recorded in Nigeria since the end of the 2016-2017 recession. The contraction during the second quarter of 2020 was largely driven by the poor performance of both the oil and non-oil sectors due to the lockdown to contain the spread of the pandemic during the first quarter of 2020. The oil sector contracted by 6.63% in the second quarter of 2020 from a contraction of 5.03% in the previous quarter, while the non-oil sector contracted by 6.05% during the second quarter of 2020, compared with an expansion of 1.55% during the first quarter of 2020. The MPC noted the continued weakness in economic activities as indicated by the manufacturing and non-manufacturing purchasing managers indices, which remained below the 50 index points benchmark. In August 2020, manufacturing and non-manufacturing PMIs were 48.5 and 44.3 index points, respectively, compared with 42.4 and 43.3 index points in July 2020. This was attributed to slower growth in production, business activities, new orders, supply delivery time, employment level, new export orders, and raw materials and input prices. Similarly, the employment level index component of the manufacturing and non-manufacturing PMIs in August 2020 were 44.6 and 44.3 index points respectively, compared with 40 and 41.1 index points in July 2020. The committee was, however, optimistic that with the easing of the lockdown and gradual resumption of economic activities, the PMIs will improve in the short to medium term. Committee expressed deep concern on the continued uptick in inflation for the 12th consecutive month, as headline inflation year-on-year rose to 13.22% in August 2020 from 12.82% in July 2020. The increase in headline inflation was largely driven by the persistent increase in the food component, which rose to 16% in August 2020 from 15.48% in July 2020. The core component also rose to 10.52% in August from 10.1% in July 2020. These upticks were driven primarily by legacy structural factors such as the inadequate state of critical infrastructure and broad-based security challenges across the country, which dampened production activities. Other factors include the disruption of supply chains following restrictions to movement to curb the spread of the pandemic, adverse weather conditions, which resulted in flooding of farmlands, as well as the inflation passed through to domestic prices following the depreciation in the exchange rate. The recent increase in energy costs is also expected to further impact the domestic price levels in the short term. Committee therefore stressed the urgent need for a combination of broad-based monetary and fiscal policy measures to curb the rise in inflation and contraction in output growth. This will involve targeted investments by the fiscal authorities to resuscitate critical infrastructure to improve the ease of doing business across the country. In addition, MPC believes the fiscal authorities can build on earlier efforts and articulate a clear strategy to attract private sector investments. The bank will, however, continue to take relevant steps to ensure that the detrimental risk of inflation to the economy is contained. Committee noted the various interventions by the CBN to reflect the economy, improve aggregate supply, and drive down inflation. Recent interventions were largely in the areas of manufacturing, agriculture, electricity and gas, solar power and housing constructions, among others. It expressed optimism that these initiatives will significantly ease the adverse impact of COVID-19 pandemic and set the economy on a path of recovery. So far, total disbursements from the bank's interventions in the wake of COVID-19 pandemic amounts to 3.5 trillion, including real sector funds, about where 216.87 billion has been disbursed, COVID-19 targeted credit facility, where 73.69 billion has been disbursed, agric and a small medium enterprise AXMIS fund, where 54.6 billion has been disbursed, healthcare and pharmaceutical support fund, where 44.47 billion has been disbursed, and the creative industry financing initiative to the youths, where 2.93 billion has also been disbursed. Under the real sector funds, a total of 87 projects that include 53 manufacturing companies, 21 agri companies, 13 service projects were funded. In the healthcare sector, 41 projects, which include 16 pharmaceutical companies and 25 hospitals and healthcare services, were funded. Under the targeted credit facility, 120,074 applicants have received financial support for investment capital. As regards the agricultural and small and medium equity investment scheme intervention is concerned, we have so far extended a total of 14,638 applicants, while 250 small and medium enterprises, businesses, predominantly the youth, have been benefited from our creative industry financing initiative. In addition to these initiatives, the CBN is set to contribute over 1.8 trillion naira of the total sum of 2.3 trillion naira needed for the federal government's one-year economic sustainability plan through its various financing interventions using the channels of participating financial institutions. The MPC is thus using this medium to appeal to our important economic stakeholders to take advantage of these intervention initiatives to help support a quick rebound in growth and the Nigerian economy. The bank's policy on loan-to-deposit ratio also resulted in a significant growth in credit to various sectors from 15.57 trillion naira to 19.33 trillion naira between the end of May 2019 and the end of August 2020, an increase of 3.77 trillion naira. This growth in credit was mainly due to manufacturing, where 866 billion naira has been disbursed, consumer credit, where 527.6 billion naira has been disbursed, oil and gas, where 477 billion naira has been disbursed, agriculture, where 287 billion naira has been disbursed, and construction, 270 billion has also so far been disbursed. On monetary aggregates, broad money supply rose to 6.93% year to date in August 2020 from 5.23% in July 2020, reflecting the increase in both net foreign assets and net domestic assets. Similarly, aggregate domestic credit grew by 6.94% in August 2020 compared with 9.43% in July 2020. Money market rates remained relatively stable in the review period, with some mild volatility reflecting the prevailing liquidity conditions in the banking system. The monthly weighted average interbank call rate increased to 7.38% in August 2020 from 6.25% in July 2020, while the open buyback OBB rate decreased to 8.39% in August 2020 from 10.12% in July 2020. The MPC noted the moderate improvement in the equities market during the review period as the all-share index increased by 5.78% from 24,174.75 on July 21, 2020 to 25,572.57 on September 18, 2020. On a year-to-date basis, however, the all-share indices decreased by 4.73% compared with 26,842 as of December 31, 2019. Market capitalization also increased by 5.98% from 12.61 trillion to 13.36 trillion over the same period. As a lead indicator, therefore, this improvement in market indices signposts the commencement of a broad-based economic recovery as far as we see today. The committee also noted the decrease in the non-performing loans ratio to 6.1% at the end of August 2020, compared with 9.4% in the corresponding period of 2019, due largely to recoveries, write-offs, and disposals. Committee expressed confidence in the overall stability of the banking system as reflected in the positive performance of the financial soundness indicators despite the persistence of COVID-19 pandemic. It, however, called on the bank to sustain its regulatory oversight on the industry in the light of the continuous fragility of macroeconomic indicators and the impact of COVID-19 pandemic and the growing risk of cyber attacks on business and economic activities. On the external sector, committee noted the resumption of sales to bureau de change in a bid to improve liquidity and ease demand pressure on the foreign exchange market. Consequently, exchange rate appreciated at all the windows. The Monetary Policy Committee observed the recent improvement in external reserves and urged the bank to maintain its prudent allocation of foreign exchange toward balancing supply and demand. The outlook. The broad outlook for the global recovery remains uncertain as the headwinds associated with COVID-19 pandemic persist, especially as new indications of a second spike in the rate of infections continues to dampen prospects of a near-term recovery. With several economies contracting deeper than expected, the global economy may eventually contract beyond the 4.9% earlier projected by the IMF, as the second round of spike in the infection rate has resulted in widespread localized lockdowns in some advanced and emerging market economies. In addition, the persisting volatility in global oil prices, which is likely to continue beyond the end of 2020, as indicated by the deliveries in the oil futures market, signposts the likelihood of a disorderly global recovery. The synchronized monetary policy accommodation by major central banks in both the advanced and emerging market economies portends the likelihood of a medium-term debt crisis, which may set the global economy into another downturn if not properly managed. On the domestic economy, staff forecasts suggest that the economy may continue to grapple with the effects of the pandemic throughout the rest of the year, with persistent focus on activities meant to reverse the contraction. MPC projects growth at positive levels during the fourth quarter 2020 or latest first quarter 2021, based on the anticipated positive results from the coordinated and sustained interventions by both the monetary and fiscal authorities. These interventions include the coordinated response of the monetary and fiscal authorities to curtail the spread of the pandemic, reverse the downturn in the economy, improve revenue sources in the non-oil sector, and encourage the build-up of fiscal buffers. Committee's consideration. Committee's considerations focus on major headwinds, exerting downward pressure on output growth and upward pressure on domestic prices and inflation. The key factors considered by committee as likely to exert upward pressure on domestic prices in the near term includes the prevalence of security challenges in the country, adverse weather conditions causing flooding in some farming regions, the increase in petroleum pump price, deregulation in the electricity tariffs, low crude oil prices, and exchange rate adjustment. The committee noted that available evidence does not support the view that the rise in inflation was due to monetary factors. Rather, there is overwhelming evidence that inflationary pressures reflect the prevalence of structural rigidities and supply shocks. Hence, the traditional tools of monetary policy may not be helpful in addressing current inflationary pressures. Instead, the use of policy-side measures implemented by the CBN. In the light of this, reducing MPR will signal to our deposit money banks to lend more to stimulate growth, increase aggregate supply, which should dampen prices in the immediate term. Although the committee remains committed to its primary mandate of ensuring price stability, it however noted the need to address the structural supply side issues that are putting upward pressure on production costs and depressing economic growth. To this end, committee supports the various intervention programs of the bank towards stimulating production in the agricultural and the manufacturing sectors to increase aggregate output and lower prices. On financial markets, committee considered the impact of the dwindling capital flows on yields in the equities, bonds, and money markets. It, however, observed the improvement in the equities market from the second quarter of 2020, indicating prospects of medium-term economic recovery. Members also took cognizance of the prevailing low rates in the money market and below the lower band of the standing facilities corridor as being a distortion to money market operations. Committee noted the increase in aggregate credit and encouraged further expansion in credit to employment-generating sectors to expedite growth recovery. It, however, urged the bank to sustain its regulatory surveillance over the banking system to ensure that non-performing loans remain low. Committee also noted the rising public debt profile and urged the fiscal authorities to strengthen its debt management strategy, explore other sources of revenue, as well as enhance efficiency in public expenditure. It commended the combined efforts of the federal government and the CBN in providing the required stimulus to contain the pandemic and ease its impact on the Nigerian economy. The dilemma of monetary policy. The MPC was, at this meeting, confronted by policy dilemma. Whereas MPC believes in the primacy of its price and monetary stability mandate, it nevertheless was confronted with what policy directions to focus on, given the contraction in output growth during the second quarter of 2020, which may lead to a recession if the third quarter of 2020 output growth numbers further show a contraction. It is therefore of the view that if a recession occurs during the third quarter of 2020, the committee will be confronted with proposing policy options in a period of stagflation. This is because with the recent removal of subsidy on fuel price, the increase in energy prices, and the adjustment of the exchange rate, inflationary pressure will no doubt persist unless MPC considers options that will deal with the pressure aggressively. Committee was therefore of the view that to abate the pressure, it had no choice but to pursue an expansionary monetary policy using development finance policy tools targeted at raising output and aggregate supply to moderate the rate of inflation. At present, fiscal policy is constrained and so cannot on its own lift the economy out of contraction or recession, given the paucity of funds arising from weak revenue base, current low crude oil prices, lack of fiscal buffers, and high burden of debt services. Therefore, monetary policy must continue to provide massive support through its development finance activities to achieve growth in the Nigerian economy. This is the reason MPC will continue to play a dominant role in the achievement of the goals of the Economic Sustainability Program through its interventionist role to navigate the country towards a direction that will boost output growth and moderate the level of inflation. Similarly, given that the currency adjustment was a causal factor in determining the price of petroleum products and energy prices, MPC believes that the CBN management must take bold actions to stabilize the exchange rate. Management was further enjoined by the MPC to continue to provide funding to sectors that will resolve the supply constraints in petrol pricing, energy pricing, and food availability. To support household consumption, MPC enjoined management to aggressively channel its funding to targeted households, small and medium enterprises, and consumer credit by further increasing its lending activities through its Nelson Microfinance Bank. The management was also directed to ensure that deposit money banks respond to the reduction in deposit rates by aggressively lowering cost of credit to borrowers. As regards output growth, MPC noted that air and road transportation, entertainment and accommodation, food services and education subsectors were adversely impacted by the lockdown. He therefore suggested that more efforts be put in place to continue to provide relief and funding to these subsectors so as to catalyze growth and improve output numbers. Dealing with the causal factors of inflation. In the view of the MPC, so far, evidence has not supported the rising inflation to monetary factors, but rather, evidence suggests non-monetary factors, here we're talking about structural factors, as the overwhelming reasons accounting for the inflationary pressure. Accordingly, the implication is that traditional monetary policy instruments are not helpful in addressing the type of inflationary pressure we are currently confronted with. What is useful is the kind of supply-side measures currently being implemented. MPC also expects that a downward adjustment in monetary policy rate may be necessary to further put pressure on our deposit money banks to lower cost of credit in aid of growth. Committee's decision. In the face of declining economic growth and rising inflation, the committee faced a difficult set of policy choices requiring trade-offs and sequencing. Following the above considerations, committee reviewed the choices before it, bearing in mind its primary mandate of price stability and the need to support the recovery of output growth. Consequently, committee noted that the likely action aimed at to addressing the rise in domestic prices would have been to tighten the stance of policy, as this will not only moderate upward pressure on prices, but will also attract fresh capital into the economy and improve the level of the external reserves. It, however, noted that this decision may stifle the recovery of output growth and thus drive the economy further into contraction. On easing the stance of policy, the MPC was of the view that this action will provide cheaper credit to improve aggregate demand, stimulate production, reduce unemployment, and support the recovery of output growth. Committee, however, observed that with inflation trending upwards, easing of the policy stance may exacerbate the current inflationary pressure through an increase in money supply. In addition, MPC noted the tendency of an asymmetric response to downward price adjustments by other depository corporations, thus undermining the overall beneficial impact of a reduction to the cost of capital. In the committee's view, a hold position would allow the economy to adjust to the ongoing stimulus measures put in place by the monetary and fiscal authorities to curb the downturn and allow more time for the MPC to assess their impact on the Nigerian economy. After the consideration of the three policy options, members were of the opinion that the three options to lose will complement the bank's commitment to sustain the trajectory of the economic recovery and reduce the negative impact of COVID-19. In addition, the liquidity injections are expected to stimulate credit expansion to the critically impacted sectors of the economy and offer impetus for output growth and economic recovery. In view of the foregoing, committee decided to reduce the MPR by 100 basis points to 11.5% and adjust the asymmetric corridor to plus 100 and minus 700 around the MPR. 6 members voted to reduce MPR by 100 basis points, 1 member by 50 basis points, and 3 voted to hold. 9 members voted to change the asymmetric corridor, while 1 member voted to hold. All members voted to hold the CRR and the liquidity ratio. In summary, MPC voted to 1. Reduce the MPR by 100 basis points from 12.5% to 11.5%. 2. Adjust the asymmetric corridor from plus 200 and minus 500 basis points to plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5% and 4. Retain liquidity ratio at 30%. Thank you immensely.
The Monetary Policy Committee of the Central Bank of Nigeria for September 2020, that is post-COVID. We have tried, and this is the time for questions and answers, we have tried to improve on the participation at this press conference. We have been able to invite some correspondents, so as we ease off the lockdown, so we are also easing off lockdown here.
On correspondence.
Yes. And we have some correspondents here. But we are going to we have to treat the gentlemen and ladies who are at home better by taking their questions first. And we have from Leah, that's NTA. We have here, with the present state of the Nigerian economy and the predictions of a recession, what is the position of the CBN in achieving early recovery? What is the position of CBN in achieving early recovery from a projected or a predicted recession? That's the, if if it will come. And we have other correspondents here, and so our editors. If you have a question, please rise up and take the microphone and ask your question. Thank you. Nancy, Chief.
Thank you, sir. Good afternoon, Governor. Let me start. I have about 3 questions or so. From the 16th of March 2020, after a few days since the outbreak of coronavirus in Nigeria, the CBN announced and also took certain measures to support the economy. In your speech, you did read out how much so far has been disbursed to certain sectors. The question is, how do you calibrate the impact of these measures? Because the economy is in a recession, and that's number 1. Number 2 is, what do you think has been the impact of COVID-19 pandemic on the financial soundness of Nigerian banks? If you take a look at the US Fed, for example, they've ordered a new round of stress tests on US banks. In fact, the Fed also prohibited banks in the US from issuing dividends and stock buybacks amid this pandemic. The question therefore is, can banks loan businesses and consumers in a prolonged or contraction or even a recession? How much of soundness is for Nigerian banks? Then the last question is the removal of subsidy, the hike in electricity tariffs, the Naira depreciation we've seen in the last few days. Naira has been depreciating, in fact today 465 at the BDC segment. How will it also lessen inflationary measures and also depress purchasing power? How will the CBN tackle the offshoot of this? Thank you, sir.
Thank you, Chief Nancy Ilonaji of IIT. Okay, Chinemere of Arise Television.
Good afternoon, Governor. My name is Chinemere Joseph from Arise News. Quite particular about the interventions of the bank and then how it would be supporting the fiscal authorities in helping the economy out of this doldrum that we are in. Now, the economic sustainability plan was 2.3 trillion naira. The CBN is expected to support this with about 1.8 trillion naira. So I'm wondering how you'll be doing this, even though you have just said that you'll be expecting some contributions from various financial institutions. How would you really be, what would you be telling them? Would you be giving them some, telling them this and this is what we want from you, or what conditions, and how would you be going about raising that money? And then secondly, during the annual conference by the bankers in Abuja here, you have talked about the banks having increased lending to the agricultural sector from a low of 1% to 4%, and then you proposed 10% by 2024, if I'm correct. So how would you be, or what sectors would you be saying have contributed to this 4%, and how would you be achieving the 10% you have proposed in increasing lending to the agricultural sector? Thank you.
Thank you so very much. I think those are the questions that we have ordered.
The first question was one of the 3 questions from Nancy asked that what do we think has been the impact of the global COVID-19 pandemic on the financial soundness of Nigerian banks. But let me respond to this by saying that ordinarily what some critical analysts will say is that as a result of the lockdown, both people and companies will not earn revenue, and because they are not going to earn, or they are not earning revenue, they will not be able to pay salaries, and if they cannot pay salaries, they will not be able to pay their loans if they took bank loans, and of course, if they cannot pay their bank loans, that it will result in non-performing loans in the books of the banking industry. But we believe that realizing that this could be the consequences of the pandemic, not just on households and businesses, but also on banks, we took the unanimous decision, supported by our board and MPC, to say that the CBN should consider the possibility of granting some kind of provisioning dispensation for banks. What does that mean? That banks are given the opportunity that if, for instance, companies or households or businesses that are impacted by the pandemic, that the bank should give, if they cannot pay their loans, that those loans should be restructured with the understanding that truly they have been adversely impacted by the COVID and that they cannot service those loans, or they have not even been able to pay salaries, let alone servicing their loans. We also took a decision to say that let us reduce interest rates on CBN intervention facilities from 9 to 5%. We also said that in order to encourage people to come back again to business, that there are those who lost their jobs, whether you are working in a hotel, you are a waiter, or you are a cleaner somewhere, you lost your job, that we should be able to make available to them what we call 100 billion naira targeted facilities for household and SMEs. This facility has been granted, and we're talking about 500,000 naira to somebody who wants to start a petty business, and up to 1.5 billion naira to some of them who are going to be undertaking some slightly higher level of business. We also decided that we will grant additional loan facilities even to some of our large companies. We decided that 100 billion naira should be set aside for companies that are in the healthcare and the pharmaceutical sectors. So what we have done, in essence, is to look for one way to reflate the economy so that people who lost jobs or people who don't pay salaries can come back again. And we believe that with the loans restructured, at least for some time, interest rebates on their loans and the rest for about 1 year, that the level of NPLs will in fact at worst remain stable, or at best we could even see it coming down. So as a result, how has that affected the financial soundness of banks? We have a data that shows, for instance, that the Nigerian banking industry remains strategically strong and able to support the Nigerian economy. For instance, in June 2019, capital adequacy ratio for the banking industry was 15.3, but as at August 2020, it has still remained at 15.3. Non-performing loans as at June 2019 was 9.4, and like I read in the communique, today it is 6.1. Liquidity ratio was 48% in June 2019. Today it is 36%, and understandably so, because we have seen an increase in credit over the last 13 months, 12 months or 13 months, of about 3.7 trillion naira into the economy. Return on equity of banks, which was at 24% as of June 2019, today stands at 21%, which we still consider very good. Return on assets of banks, which was 2.3% in June 2019, today is at 1.9%, which we still adjudge to be fair. Total deposits of banks have risen from 22.9 trillion in June 2019 to 28.9 trillion in August 2020. Total loans have increased from 15.4 trillion naira in June 2019 to 19.33 in August 2020. Total assets have also risen from 38 trillion in June 2019 to 48 trillion in August 2020. So these for us are signs that shows that at least to date, the economy, the banking industry remains resilient to support the growth of the Nigerian economy. The other question that Nancy asked related to the fact that he said in March 2020, just about the period of the outbreak, that the CBN took certain measures to support the economy, and that what has been the impact of these measures on the economy, positive or negative. Like you all know, the pandemic resulted or created a global health crisis, which ultimately dovetailed into a global economic crisis. And Like we've already said, we've reeled out all the various actions that we took: interest rate on interventions, restructuring of loans, granting of targeted facilities. And let me repeat myself because I said so in the communique. We provided 100 billion naira for targeted facilities, and to date 78 billion has been disbursed to 130,000 beneficiaries. For the 100 billion naira healthcare, 44 billion naira has been disbursed to 16 pharmaceutical firms and 25 hospitals. And we believe this will help go a long way to address some of our health and pharmaceutical crises. Out of the 1 trillion naira agri facility that we, agri and manufacturing facilities that we said the bank should be able to benefit from, this company should be able to benefit from, we've so far disbursed 216 billion naira, and this has been disbursed to 53 manufacturing companies, 12 agri-related companies, and 13 services projects. On our Agri and Small Enterprises Fund, we have so far disbursed to 144,600 beneficiaries, a total of 54 billion naira, and these are the loans that we said were granted by way of giving the real implements needed either for poultry or for hairdressers or those who are doing fashion and the rest of them. And of course, for the creative industry, we have also granted loans to about 250 youth companies, and they are benefited to the tune of about 2.9. So what has been the positive impact? I would say it has been positive because truly, if this had not come, perhaps one, we may not have seen the positive GDP we saw during the first quarter, or a somewhat reduced contraction that we saw during the second quarter of 2020. So I would think that these things have been quite impactful, and we should really commend those who have played an active role. And I think I must commend our colleagues in the Development Finance Department who have done a great job in this. Now, Arise asked a question. He said the economic sustainability plan was benchmarked on about 2.3 trillion naira, and that out of it, the CBN, which should be through some kind of debt funding, should be funding close to about 1.8 trillion to support and catalyze the economy. And she asked, how does CBN plan to achieve this? Again, repeating myself, we have already disbursed a substantial sum of money, and we would repeat and say that these funds have not been fully drawn, and it is just a request, and we would like to appeal, like we also appeal in the communique, that there is available funding at low interest rates. All we need is for businesses and those who plan to conduct businesses to get back to business. As government improves the level of easing of lockdown, we should get back to our businesses, talk to our deposit money banks, and we ourselves will also be talking to them. We are holding meetings with them regularly, for them to see to it that the Nigerian economy must get back on its feet, and that we all need to work together to grow this economy. And so, business owners, stakeholders in the business community would like to appeal to you, because for instance, out of the 1 trillion naira that we made available to the agri and manufacturing companies, only about 216 billion has been drawn. So it means close to almost about 800 billion naira is still available. And we would like to say that you should all join us to work together on this. Chinemere and Arise also said that during the CIBM annual conference, I had said that agri loans had grown from, say, 1% to 4%, and that there is a need for us to see how to even encourage the banks to increase lending to agriculture to 10%. You will see that whether we like it or not, any analyst looking at the Nigerian economy will say that for us to achieve growth, for us to create employment, we cannot ignore the agri sector. And that is why you all would observe that since 2015, when President Muhammad Buhari assumed power, all that he has concentrated on at least in the area of economy is to say that we should revive the agricultural sector. And the Central Bank of Nigeria has held itself out over this period and done a couple of things, either through supporting through an corporate program to make smallholder credits available to our smallholder farmers, whether for rice or for tomatoes or for maize or for sorghum or for cassava or fish. These facilities have been made available. And these have been responsible for increase in agri credit from 1% to 4%. And I have a few numbers. For instance, in May 2019, loan to agro services was 324 billion. But as at today, August 2020, right, loans to agro services have gone up to about 430 billion. For crop production, outstanding aggregate loans to this sector was 163 billion in May 2019. August 2020, it had grown to 294 billion. For cash crops, loans to this cash crop subsector was just 90 billion in May 2019. As we speak today, it is 129 billion. And of course, there are other sectors as well where we saw loans at 79 billion, but today stands at 91 billion. So what am I saying? In aggregate, we've seen loans to the agri sector rising, right, just within just this short period, from about 658 billion naira to about 900, almost 1 trillion naira during this period. About close to 300 billion naira loans have been granted to support the agri sector. And I can expect that with what we are doing to ensure that we support the agri sector, we just will continue to appeal to more and more people to come in, whether you have your own funding, don't put it in the bank account, bank deposits, go out and get involved in some of agricultural activities. We can be involved in process of, not if you are not involved in primary agri farming, you can also be involved in the business of making food, moving food from farm to market. You can be involved in the business of processing these agricultural products. You can be involved in the business of moving these agricultural products to the supermarket, and the rest of this will create opportunities for wealth creation and also help to grow our economy and also create jobs to employment stimulating sectors of our economy. So I want to thank you. I hope I've tried to respond to your questions. In the communique, we talked about the fact that the MPC gave the management the money to see to it that everything is done to stabilize the exchange rate in the country. And I thought it's important for me to address it because there are unfolding events arising from this. And what I like to reiterate from that what MPC requested management to do is that today, whether I would like it or not, the global crisis has come. And usually when there's a crisis of this nature, because, for instance, there's pressure on exchange rate, what we've had to do is to adjust exchange rate. So what we've done, we have adjusted prices. But if you adjusted price, there's a need for you to also look at how do you work on supply and demand. In working on supply, we are seeking to see how can we diversify our revenue base in foreign currency. And we're thinking of how to really give support to those who are interested in doing more export business. We would like to encourage them. Before now, we've seen people doing exports, but we need now to even be more aggressive to support export activities so that we can grow our foreign currency revenue base from export. It is important that I say this and that there is no need for anybody to go into undocumented export activities in the country. We've seen situations where people get into undocumented export activities through open accounts, and the central bank will be working with Nigerian customs and the shipping lines and shipping agencies that when you conduct an export activity, you must fill your NXP forms, and that the shipping lines will not be allowed to carry your export out of the country unless you fill NXP forms. And that if we discover any exporter involved in open accounts where he did not fill NXP forms, we will deal with those exporters. We want all the process of exports and foreign currency revenues to go into an account where all of us will see it, it will be visible for everybody. That's on the supply side. On the demand side, we also say that there's a need for us, and you all will recall that since 2016 we've been talking about reducing imports, particularly of goods that we can produce in the country. And there is a need for everybody to work together to ensure that we all begin to embrace the consumption of food that we produce in the country. And that is the reason the presidency, the government, the CBN, monetary and fiscal authorities are saying, we are ready to provide funding for you as long as you want to go into agri, so that we can increase food production that our people badly need. So we will frown at people who think that they can import items that can be produced in the country. And we have heard the president speak about this, saying several fora that the Central Bank of Nigeria will not be allowed, should make it difficult for people who want to take foreign exchange from the Nigerian foreign exchange market to import food. We will continue and with a lot of intensity to see that this is done. And we would like to please appeal to everybody. We all need to work together. And when we produce these goods locally, it behoves on us that we must patronize our own locally made goods. And what does that also mean? That the central bank will come out very strongly on those who are involved in smuggling or in dumping of goods that have been restricted to forex. And they will be dealt with in line with the law, and would like everybody to please seize opportunity to be patriotic, that we need to support and embrace and consume food that is produced in Nigeria, rather than food that is imported as in being smuggled to the detriment of our Nigerian-made goods, and therefore make our locally made goods uncompetitive in pricing. So I just thought I should talk about this so that we all know where CBN stands on these issues. I thank you all again.
Thank you. Thank you, Governor. Distinguished ladies and gentlemen, we have come to the end of this briefing. It remains for me to thank you and wish you well. Please remember, put on our masks and make sure we eat foods, Nigerian-made foods that are very rich in vitamins, in zinc, in calcium, and others. I want to say thank you for your attention, and we'll see you again in November. If I have the governor's permission, I may not be there in November because I'm retiring. Thank you so very much. It's been a very good time.
So let's really thank Isaac for a good job, and we hope your producer will do at least equal, if not better than you've done. Congratulations on your retirement, and so please enjoy your retirement. Thank you. See you all. Thank you. November.